Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 27th, 2025. Good morning, everyone. I'm glad you could join me today as we dive into the market's highs, lows, and everything in between. Let's get started with a quick overview of what's moving the markets today.
Right off the bat, our broad market indexes are showing a mixed picture. The S&P 500 presently stands at roughly 5,690.92, slightly down by nearly negative 0.08%. The Dow Jones Industrial Average isn't looking much rosier either, trading around 42,279, down by almost negative 0.36%. Meanwhile, the Nasdaq, with its tech-heavy focus, sits around 17,816, managing a tiny positive movement, up by about 0.03%. The small-cap Russell 2000 holds at roughly 2,065, down by nearly negative 0.34%. And on the crypto front, Bitcoin is trading in at about 85,986, losing roughly 1%, while Ethereum is at 1,991, down by almost negative 0.9%.
It's an interesting start to the day as markets are showing cautious sentiment. When you look at these minute changes, they remind me of that old saying, sometimes it feels like watching a pot that's just slowly boiling, except in this case, the pot might even be cooling off just a bit.
Let's move on to a deeper dive into major market trends. This morning, we see a nuanced landscape. The traditional equity markets seem to be straddling a line between consolidation and underlying uncertainty. With the S&P, Dow, Nasdaq, and Russell all hovering around their recent levels, the overall market sentiment suggests that investors are in a wait-and-see mode, digesting a mix of global cues and domestic economic data. Although the Nasdaq's marginal positive tick might be pointing to pockets of strength, perhaps in tech and innovation sectors, the overall narrative remains cautious.
Speaking of caution, let's talk about the broader macroeconomic context. Price pressures and inflationary signals are beginning to make themselves felt again, albeit subtly. Investors are wary that any sign of overheating could prompt the central banks to change their policy stance. There is a fine balance at play. If inflation ticks up beyond manageable levels, we might see central bankers pull the emergency brake. And if they do, you best believe it can lead to a more pronounced market correction. It's always a balancing act between encouraging growth and curbing inflation. In today's environment, there is a palpable sense of what's next amongst investors.
Now, a deeper question arises. Are these small percentage moves indicators of broader structural shifts, or are they just transient jitters amidst a backdrop of robust economic fundamentals? Personally, my take is that while there are underlying risks, the fundamentals remain sound. However, the potential for a policy shift by the Federal Reserve, or perhaps significant global economic events, could suddenly tip the balance. It's this exact uncertainty that makes our work so fascinating, and admittedly, sometimes even a bit nerve-wracking. But hey, if markets were predictable, we'd all be out of a job.
Now, let's roll up our sleeves and get into comprehensive coverage of the key stories making the rounds today. We have a couple of heavy hitters that I'm particularly excited to break down.
First up, in the tech world, word is circulating that Nvidia is reportedly in talks to acquire Lepton AI. This potential acquisition has got everyone buzzing. Nvidia has been known as a powerhouse in graphics processing and artificial intelligence, and Lepton AI's capabilities in the AI space could potentially accelerate Nvidia's roadmap into next-generation solutions. If this deal goes through, we might be looking at an even more pronounced shift in the competitive landscape for tech hardware and software integration. It's like watching your favorite sports team add a star player right before the playoffs. There's a lot of anticipation and a little bit of drama building up.
In a completely different corner of the market, we have some news that's causing ripples in the shipping and logistics sectors. One ocean carrier has been making headlines, stating that if fines on Chinese-built container ships start rolling in by the U.S. government, and this isn't a small matter, we're talking about fines in the realm of millions, then the carrier feels that they're practically forced to exit the U.S. market. If that happens, freight rates could very well tumble back to those reminiscent of the COVID days, when supply chains were reeling from unprecedented disruptions. I find it particularly fascinating how even a slight regulatory shift can have such far-reaching consequences, almost like stirring a cocktail where one ingredient throws off the entire flavor profile.
Switching gears a bit, a recurring theme in financial circles has been the upcoming confirmation hearings for the SEC chair. President Donald Trump's nominee, Paul Atkins, is set to undergo questioning from the Banking, Housing, and Urban Affairs Committee. This hearing is crucial because the incoming SEC chair will likely be at the helm during some turbulent times ahead, where financial markets are concurring with the new era of regulatory oversight. The questions coming out of the Senate confirmation hearing could provide clues as to the future direction of market regulation. Will we see tighter asset protection protocols, or perhaps more leeway granted to innovative financial products. It's a scenario rife with speculation, a bit like trying to predict the plot twist in a well-written novel.
On the merger and acquisition front, SA Charts reports that the U.S. merger and acquisition deal volume fell nearly a quarter sequentially in February. This slowdown in deal-making can be interpreted in several ways. On one hand, it might underscore a growing caution among corporate executives who are reluctant to commit during uncertain times. On the other, it could imply that companies are taking a more strategic approach as they weigh risk versus reward in today's volatile economic environment. Fewer deals might also signal a waiting period until the dust settles and confidence is restored in the markets, much like waiting for the rain to pass before stepping out in your best attire.
Meanwhile, in the world of private equity, KKR is reportedly nearing a buyout bid for Japanese medical gear maker Topcon. This move underscores the global nature of capital flows these days. With demographic changes and rapid technological advancements reshaping industries, investors are increasingly looking at opportunities beyond their home turf. KKR's potential move in Japan is a classic example of a firm betting big on technology and reliability traits that are in high demand in the medical gear space. And speaking of cross-border moves, international retailers aren't sitting idle either.
In another notable piece of news, Canada's Dollarama is reportedly set to buy Australia's largest discount retailer, The Reject Shop. This acquisition highlights the continuing trend of international consolidation in the retail space, as companies look to expand their geographical footprint, diversify revenue streams, and tap into emerging consumer markets. It's interesting to note how globalization continues to influence even the most traditionally local sectors.
While these stories have dominated the headlines, I want to take a moment to acknowledge that some news items have been echoed more than once today. Yes, you heard it right. Multiple mentions of the Chinese-built container ship fines as well as the SEC chair confirmation hearing have come up repeatedly. Now, this repetition might feel like an echo in a canyon, but it serves as an important spotlight on the issues most pertinent to today's market, namely the heavy regulatory implications and the practical consequences they bear on market participants. It's a reminder that certain stories are simply too significant to be relegated to the background.
Now let's move on to a detailed sector analysis. In technology, the potential Nvidia Lepton AI acquisition is a story that we'll likely be following closely in the days ahead. Tech companies have always been at the forefront of innovation, and any significant move in the AI space tends to send ripples across related sectors. It's not just about hardware. The implications for software integration, data analytics, and even cloud services are enormous. As we've seen in the past, when a tech giant expands its capabilities, competitors are forced to react, sometimes leading to price corrections or even inspiring new innovations. One might even say that the tech sector thrives on a cocktail of bold moves and creative disruptions, a bit like a well-prepared martini, shaken not stirred.
In the energy space, there's an undercurrent of caution that we need to be mindful of. Global energy markets are always sensitive to regulatory changes and geopolitical developments. While the headlines today might not scream energy crisis, the underlying supply chain issues and environmental regulatory pressures are sure to have implications. Companies in the energy sector are currently dealing with a dual challenge: managing existing production efficiently while simultaneously transitioning to greener practices. It's a bit of a dance, and anyone who's ever tried dancing tango knows that it takes a perfect blend of precision and passion. Entity firms are having to fine-tune their operations down to the smallest detail, balancing short-term profitability with long-term sustainability.
Turning our attention to finance, the regulatory landscape remains a hot topic. With the incoming SEC chairs hearing drawing significant attention, financial institutions are bracing for potential shifts in market oversight. Banks, asset managers, and trading houses are keenly watching these developments, as any tougher regulatory stance could lead to a recalibration of risk and reward. It's interesting to consider how recent moves by regulatory authorities have sometimes transformed entire business models overnight. Imagine a financial institution suddenly finding itself with a different set of rules. It's like playing poker, where someone just switches the deck in the middle of the game. The implications of such changes can be profound, affecting everything from day-to-day trading to long-term strategic planning.
In the retail sector, the cross-border acquisition we mentioned earlier is a signal that companies are diversifying and branching out into new markets. Canada's Dollarama's move to acquire Australia's largest discount retailer points towards a view that even amid economic uncertainty, strategic expansion can yield attractive returns. Retailers are adapting to shifting consumer behaviors that have been altered by decades of rapid technological change. As digital platforms continue to expand, traditional brick-and-mortar establishments must evolve. The merging of physical retail and online sales models suggests that firms that can adapt their strategies will continue to thrive in this new environment.
Now let's turn our gaze beyond domestic shores and discuss global market implications. Internationally, investors are keeping a close watch on the U.S. regulatory environment, especially when it comes to trade and capital flows. Regulation on container ships might seem like a niche issue, but when you consider the size of the global shipping market, even a minor shift can cascade into wider economic repercussions. What happens in the shipping lanes can ultimately affect everything from commodity prices to inventory management strategies in retail. In fact, many analysts are suggesting that these container ship dynamics could serve as an early warning signal for broader trade policy shifts between the U.S. and China.
It's not just about regulation either. The potential acquisition moves in tech and private equity point to a more interconnected global market where capital flows without borders. The KKR move in Japan and the Dollarama acquisition in Australia remind us that opportunities exist everywhere and that investors with a global mindset stand to benefit the most. There's an old adage that goes something like, when one door closes, another opens. In today's market, that door is often located on another continent, ready to unlock new possibilities.
Let's now move into some expert insights and predictions. Looking ahead, I would say the short-term outlook remains one of cautious optimism. While the markets are currently reacting to a mix of regulatory signals and global economic uncertainty, history has taught us that periods of volatility are often fertile ground for innovation and growth. For instance, if Nvidia's potential acquisition pans out, it could accelerate growth within the tech sector, spur new product developments, and ultimately contribute to a more robust market outlook for technology stocks. Likewise, while the impending regulatory changes in finance have many independent and institutional investors a tad jittery, stability might return once the dust settles and clear guidelines are established.
From a macro perspective, the key area to watch will be inflation and monetary policy. Central banks are ever vigilant about inflationary pressures, and any sudden re-escalation could prompt a swift policy shift, a development that would undoubtedly result in increased market volatility. Investors may want to keep an eye on economic indicators such as consumer spending, manufacturing output, and job growth rates. Even small moves in these indicators can have outsized effects on market sentiment. It brings to mind the notion that even the smallest pebble thrown in a pond can create ripples reaching far into the distance.
I'd be remiss if I didn't also point out a bit of humor in all this. Sometimes reading through these numbers and percentage changes, I can't help but think that it all seems as unpredictable as my cat on a sunny afternoon, 1 minute napping, the next dashing around the room without warning. And yet, just like that cat, the markets have their own seemingly erratic behavior that, when looked at closely, follows a sort of unpredictable pattern that we learn to navigate over time.
So what does all of this mean for you, our savvy investors and traders? First, it means that adaptability is key, whether it's the tech sector riding on potential game-changing acquisitions or the finance sector bracing for regulatory clarity. The ability to pivot, sometimes on a dime, is more valuable than ever. It also means that keeping your finger on the pulse of both global trends and local market nuances will be crucial. Are we on the brink of a new paradigm in market regulation? Will technological advancements continue to pave the way for robust growth? Or are we on the cusp of facing a more turbulent ride? These are the questions both seasoned veteran investors and newcomers alike should be pondering as they plan their next moves.
Before we wrap up today's brief, let's revisit a few of those key points that echo through the market today. We've got significant movement, albeit small, in the major indexes, hinting at an environment of deliberate caution. There's excitement brewing over potential tech acquisitions that could reshape industry dynamics, and at the same time, regulatory news from container ship fines to SEC confirmation hearings has set the stage for potential upheaval in both finance and international trade. Meanwhile, strategic moves in merger and acquisition activities hint at both a cautious approach and a forward-thinking mindset among corporate players.
I also want to highlight the underlying takeaway here. Markets today are a tapestry of global interdependence. Regulatory decisions in one part of the world, or even in a single sector, can have far-reaching implications across continents and industries. It's this interconnected nature that makes our market such a fascinating puzzle to solve every day, and keeps us talking, predicting, and yes, sometimes laughing at a sheer unpredictability of it all.
As we look to the future, I encourage you to think about this. How will the interplay of technological innovation, regulatory changes, and global economic trends shape our investment strategies over the next year? Are we primed for a period of consolidation before a major breakthrough, or are there subtle hints that point to a rapid turnaround in investor sentiment? These are the kinds of thought-provoking questions that can help guide your decisions and ultimately foster a deeper understanding of the market's rhythm.
Of course, it's not just about numbers. It's about the human element lurking behind every trade, every acquisition, every regulatory decision. Behind each percentage point headline, there are real investors navigating their portfolios through an ever-changing landscape. Sometimes it helps to remember that at the end of the day, we're all in this together. From the institutional investors with multi-million-dollar accounts to the individual trader keeping an eye on every market tick, all of us are part of this grand, exciting narrative.
Let's also take a moment to highlight some humor in our industry. I once joked that the only thing more unpredictable than market trends is my morning coffee. You never quite know if it's going to be a strong shot to keep you energized or just a lazy sip that leaves you wondering where the energy went. And much like that unpredictable cup of coffee, the market often surprises us with a jolt when we least expect it. But that unpredictability is exactly what makes our job both challenging and endlessly fascinating.
As we draw this morning briefing to a close, let's revisit the key takeaways. The major indexes are moving in a cautious fashion, a reflection of underlying global uncertainties and careful investor sentiment. Significant corporate moves like Nvidia's potential acquisition and KKR's buyout bid signal dynamic shifts in industry landscapes, while regulatory issues, especially in shipping and finance, are setting the stage for potential longer-term market implications. All the while, investors are reminded that even in times of uncertainty, opportunities abound for those who remain agile and well-informed.
I'd like to give a big shout out to Pantheon AI, your information co-pilot, for helping bring these insights right to your ears this morning. Our job is to ensure that you're never in the dark about what's happening in the financial landscape, that you have the information you need to make informed decisions, and that learning doesn't feel like a full-time job.
Before we sign off, I want to leave you with a couple of thought-provoking questions. In the face of tightening regulations and global economic shifts, what strategies will you adopt to ensure your portfolio remains resilient? And how will you balance the lure of technological innovation with the caution required in today's volatile environment? I invite you to mull these over as you prepare for your next trade or investment decision, and of course, feel free to reach out and ask questions to our AI co-pilot.
Thank you for joining me today on this deep dive into the financial markets on this fine March 27th, 2025. I look forward to our conversation on the next episode tomorrow. Until then, keep your mind sharp, stay curious, and remember, learning shouldn't feel like a full-time job. Have a great day, everyone.